Let me tell you a little bit about Euler Hermes. We have 50 underwriting offices around the world in over 200 countries. We have thousands of policyholders worldwide utilizing our services. Credit insurance is designed to protect you from any unexpected bad debt losses due to insolvency or slow pay. You ever had a company slow paying on you, trying to extend that payment period? If that happens, we will protect you against it. We will also protect you against Chapter 7, 11, 13, or even a general creditor's meeting in an insolvency case. So 7 is of course liquidation, 11 is a reorganization of the company. Filing a slow pay claim, you have 90 days from due date or the extended due date. The one thing, anyone heard about factoring? See? Well, here's the one thing with factoring. Factoring is kind of, they buy your invoice, right? And they collect on their behalf. So on their behalf, they want their money. We don't want to mingle in that relationship. We want to get you in front of your own customers. We want to perceive that relationship. I mean, I'm in sales, you're in sales. You do a great job in establishing that relationship. You go through lengths to get that relationship. You don't want any third party to mingle in that relationship, which they can destroy. So we allow you to be in charge of your own accounts receivables management. Okay? That's kind of what credit insurance is designed for. Protect you against unexpected bad debt losses. So, is anyone, by the way, ever using Dun & Bradstreet? Yeah? Dun & Bradstreet, you look at trade references, you look at your own payment experience. All of that information allows you to make a good credit decision. However, with credit insurance, we allow you to make that good decision, we allow you to make that better. We have a proprietary database of over 45 million companies around the world. We monitor these companies on a monthly basis. And through this database, you have access to thousands of underwriters around the world gathering information on your prospective buyers. So in that database, we've accumulated a risk rating on these companies. With the financial information which we have on 45 million companies around the world, we've created a risk rating from 1 to 10. 1 is exceptional good. There'll be the Walgreens, the Walmart, or Excel perhaps. No, I haven't looked in that yet. But 10 is failed. 10 is you're out of business. That's what we don't insure. But anywhere between 1 to 7, 9 is nearly failed, 8 is insufficient information. Don't go into much of detail of that yet. But we allow you to make a good credit decision when you take on a new customer, when you extend terms to that new customer, when you explore a new market, right? We also have credit insurance to manage you against that unexpected bad debt. I mean, most of our clients don't expect where that bad debt is coming from. And I'll get to that in more detail, but you have a client who you've been dealing with over 15 years. Suddenly they go insolvent, they file for Chapter 11. You don't see it coming, we didn't see it coming, and we will protect you against it. Now, credit insurance is implemented for one of the following 5 reasons. The first one is the catastrophic loss protection. What will happen if one of your largest customers goes insolvent? What do? I mean, you don't get your money for what you sell. It will hurt your company's cash flow and your profitability. And that's why companies implement credit insurance, protect them from that large exposure, that large loss. Okay, if we look at one example of a company here, the company name is fake. I can't really name drop any companies apart from the bigger ones out there, the Samsungs, the LGs, OEC, Taiwan shipping company out of the port of the lake. They all utilize our services. This particular company, they had an annual sales of $2 million, and they took out a policy with us for $7,500. And one of their largest customers became insolvent, and they suffered a $125,000 loss. Now, for a 2 million company, that's huge. I mean, how can you get over that? Well, we kept them in the black because we paid out on that claim. They actually had, and that's what you see here, they actually had a customer who went insolvent. So they tried to slow pay on their customers, trying to get more credit and more spread their payments to other customers. And that's what we protect your business against, if that ever happens. Okay, so we kept them in the black. They're still in business, they improved their sales, and I'll tell you in the next slide how we expand those sales. Because sales, credit insurance, with credit insurance you can aggressively grow and also mitigate your risk. An aggressive growth strategy is much easier to maintain with credit insurance. I mean, we help you identify those buyers, those customers, new markets, what I've just said, through that database of 45 million companies around the world. So, quick example, we have a seafood company out of San Diego, Seafood Inc. Their annual sales were also $2 million, but they were only exporting. So they were exporting to Portugal, Mexico, Spain, and with a policy of $70,000, which they invested, because I mean, if you export, the risks are greater. So we also want to mitigate that risk, see if we get our money back. They invested $70,000 in a policy with us, and we allowed them to explore new markets. We allowed them to be more competitive in these markets where they sell into, and that's really where we help them with, because they were competing with, of course, European companies out there selling their products, and they might sell on 60-day terms. Now we allow them to do the same thing from America, ship to 60-day terms, and make sure they get paid for it. And that's how we help companies expand, be more competitive in open markets. Any company with a loss history can reduce future losses. I mean, it allows them to take that bad debt in, and it also allows them to price their products more competitively. They don't have to worry about a bad debt which they have sitting aside. They can eliminate the bad debt, and I'll tell you a little more about that later, and put that money back into their products. Right. Same with bank financing. Banks will grant better terms and structure when presented with accounts receivables that are insured. This will allow for more availability on the working capital, and banks will lower the borrowing costs. So if you have a working line of credit with a bank will allow you to take on credit insurance, and they will lower your borrowing costs. Lots of American companies are not using credit insurance yet, but what American companies do, they put aside a bad debt reserve. So they put aside $200,000, right, in case something happens. Once they get a bad debt write-off of $200,000, that reserve goes back to zero. So that's usually $1 for $1 allowance. However, with credit insurance, if you invest that $200,000 in credit insurance, you might even end up with $200 million of coverage on your entire company. As I already mentioned, companies may be in a position to eliminate the need for their international customers to carry a letter of credit. It allows them to be more competitive. Letters of credit can be restricted, expensive. Our solution is just a lot more cost effective, especially with banks. How many of you know the percentage of banks, how much do they allow you to borrow against the international customers out there?
No idea.
40%? No, it's zero. Banks will not allow these foreign accounts receivables to be part of a borrowing base, on a working line of credit. Zero. That's what we help companies with. With credit insurance, if a bank knows your company has credit insurance, the bank will give you an advanced borrowing rate against your export accounts receivables. In addition to banks not allowing you to borrow on your foreign accounts receivables, which you now can with credit insurance, we also cover political risk. We also cover foreign changes in regulations, so import and export regulations. We allow you to obtain hard currency. And we also protect you against foreign government non-payment. So if a foreign agency blocks a payment, we will cover the company who suffered a loss due to that blocking. mean, we had it a couple of years ago with Afghanistan. Afghanistan, we had a company dealing with companies in Afghanistan, and suddenly the government closed the border for payments. They had to wait 3 years on their payment. But since they had credit insurance, we paid the loss to them, so they can continue doing business. After 3 years, we received that payment, because we already paid the customer. So we received the payment, and we then make all again. And we pay pro rata, the latest percentage, back to the company who we insure. 40% of that, of your business, is usually uninsured. And I don't ever get why that is, because your accounts receivables, that's the lifeblood of your company. Your cash flow, your profitability depends on your accounts receivables. So that's why more and more companies implement credit insurance to protect them from these losses. Right? What I ask my prospects always is, what amount of loss would seriously impact your company's health? Right? And consider that, and think about how much credit have you extended to a certain account. I mean, what happens if that account goes insolvent? You'll lose that money, and that will hurt your company's cash flow and profitability. Like I said, we want to help you grow your business. We want to help you avoid sustaining losses, unexpected bad debt losses. With that, with all that concluding, I'd like to thank you for your attention.